Well, like it or not, but we're caught in a big ping-pong trade match between Donald Trump and Xi Jinping. Now, the recent exchange of shots were, first Donald served one to China. Its remaining $300 billion worth of untariffed goods were slugged with a 10% tariff. China then returned serve, raising tariffs on $75 billion worth of goods last Friday. Donald then went tweet mad, ordering US companies to leave China and come back home to produce. He then doubled up, raising tariffs. Those that were 25%, he then pushed to 30%. Not helping was Jerome Powell at Jackson Hole, Wyoming, not saying the right things about interest rates, and that didn't help the stock market. And not surprisingly, the Dow was off over 600 points, and our market really copped it today. So, and also it's interesting, Reserve Bank Governor Phil Lowe spoke at the same conference as Jerome Powell, and he's basically made the point that these political shocks are now becoming economic shocks, and that's probably a major concern going forward. So, and also interesting today, Citigroup in the US, this economics team, thinks that there's now a 60% chance that there will not be a trade deal by November 2020 when the election's being held. You have to hope that they're wrong. Anyway, how worried should we be? Let's talk to the people who are playing the markets all the time. Julia Lee from Burman Invest, Michael McCarthy from CMC Markets, Charlie Aitken from Aitken Investment Management, and our own Paul Rickard. And we'll also talk to Paul Bloxham from HSBC, Chief Economist there. All right, guys, this current sell-off, is this something we should be scared of? Is it going to get worse and worse and worse? Julia.
You should be terrified. No,
she's joking with our money going.
I think when it comes to investment, there's always something to be terrified about. During the global financial crisis, it was, the banking system going down and systematic collapse. And after that, it was, the problems in Greece, the problems in Europe. There always is a problem. I think the more important thing for investors to be aware of is where we are in the economic cycle and then how to position portfolios for that cycle. And I think where we are at the moment, we're looking at a world of very low interest rates and rates that are continuing to fall. So the way I would play it is through real assets like Sydney Airport's Transurban, Auckland airports, which I think will continue to be well supported, or something like gold, which works well when in times of volatility, together with the falling Aussie dollar, or through some of those key exporters that benefit from that lower Aussie dollar.
So you're looking for quality companies, gold companies, and exporters like CSL and Cochlear. They seem to have done well, even despite the fact all these challenges out there in the global economy.
Yeah, I'm looking for two things. One is, as you mentioned, real assets that have limited supply, so things like Auckland Airport, Sydney Airports, even gold to a certain extent. And then the other way to play it is through the weaker Aussie dollar. So whether that's Aussie dollar gold or whether that's through those exporters like CSL.
Macca, she's got a sort of a structured way of responding to the fear. Are you more structured, or do you sort of go looking for what?
No, I'm a coin tosser, Peter.
Yeah.
No.
I'd never call you a tosser. There's no way. But from your point of view, you look at case-by-case situations, don't you?
Absolutely, Peter. And that's the thing about it. And strategy hasn't changed for 18 months. First of all, doubt the extremes. And at the moment, I believe we're seeing an extreme. But the rewards over the last 2 years have gone to active investors. Those who've sold when shares are doing well, taken some profit so that when they fall, they can buy in again. And also, we've been talking about volatility of volatility. So the markets are likely to continue to have patches of calm, followed by patches of big swings like we're seeing at the moment, followed by patches of calm. And in those periods of calm, I take advantage of the lower price of options to create one-sided exposures. So that's the broad strategy. Peter, I started buying stocks today. To me, sentiment is at an extreme, and that's what's worked for me over the last 18 months. When everybody's fearful, I buy, and when everybody's cheering, I sell.
Okay, Mr. Buffett Jr. here. So tell us what you bought today.
Well, I added to holdings today. I didn't make any new
Doesn't matter. What
selections.
did you buy?
So I bought Costa Food Group. They've been smashed after their result. I bought some more Oil Search. This is one of my favourite long-term holds. And I bought some Challenger Financial Group as a bit of an offset, because I believe they'll do very well if growth remains in question and interest rates stay low.
Okay. And Costa Group didn't report well in the reporting season before. It's had another bad report.
Absolutely. And so after peaking at around $9 in the middle of last year, its shares have been hammered, trading at $3 today, Peter. And there are good reasons for that. There have been some missteps and they've had some bad luck. And in this latest report, we heard that mushrooms and raspberries didn't go well for them in the half year. And add to that the fact that the citrus business is highly cyclical. They plant and grow in one half and then harvest in the next. And that's coming up in the next half. I think it's a good time.
Is drought and the trade war affecting them?
The trade war, not so much. The long-term trends towards pure foods are clearly a good driver for them. They have been affected by drought in some areas, but this is the beauty of a diversified food business. You know, they're not only diversified across all sorts of different foods, they're diversified geographically. So yes, that has weighed on it, but with the share price at 1/3 what it was 12 months ago, I'm prepared to take some risks on that.
Julia, have you got a view on Costa Group? Is he intelligent and fantastically smart, or is he taking risks with other people's money?
Well, I love Costa Group. I think, and I definitely love the foods. I just don't like it being stuck in this cycle where it consistently disappoints time after time. So I'd be looking for at least one positive report before getting confidence. But certainly I think the pricing is low. I'm just not brave enough to jump in.
Well, Mac is a thrill seeker. You're a very cautious
I like to see the...
She's not. She's a thrill seeker too. But okay, tell my viewers about your theory about the bad performers and the good performers reporting season, and the kind of the tendency for them to keep going badly or keep going goodly.
Yeah, I think if you go back to last week's, I had the statistics, the 10 best performing last reporting season in August and the 10 worst, and obviously the 10 best continue to outperform, while the 10 worst continue to underperform, actually had a negative return, and 7 out of those 10 continued lower. And the point of it was that not all of them go up and not all of them go down, but generally as a group, it's much easier to pick winners from the winning group rather than from trying to pinpoint that inflection point from that losing group. So,
so what I want you to do now is, because people watch this apart from the fact that they love us as a group, they want stocks from you and from you. He's already delivered. Give us, if you can, 3 really good performers out of reporting season lately, which you think will have legs going forward, and maybe 3 shockers that people might need to get out or avoid.
Yeah, I mean, I like JB Hi-Fi, and this is one that I haven't liked in the past because the retail conditions have been so difficult. And look, reporting season has proven me wrong in some of those retailers. JB Hi-Fi, Baby Bunting's done well, and Adairs today as well, which looks at the linens and the Adairs has done well too. So look, I think there's selective retail options in the market, and that's been a nice surprise coming out of reporting season. I think the other part is the building construction area. That's been quite a divisive area. I think on one hand you've got the James Hardys of the world doing relatively well, and Lendlease also underperforming, and then today Boral doing horribly. So look, I like James Hardy rather than a Boral exposure, and Lendlease continuing to, I guess, get some support, especially if they do manage to divest that engineering division. And look, the other area that I found quite interesting were the salary packaging novated companies, novated leases companies, whether it's Smart Group, Macmillan, Shakespeare. They've all seen considerable support this reporting season.
Eclipse has done well.
And Eclipse has done well too. And I think for me, reporting season is a chance for me to see what underlying trends continue, which have stopped and reversed course, and which are going.
Okay, if someone's watching this and has never ever bought a stock before, all the ones you've mentioned, which one do you like the most?
At the moment, JB Hi-Fi. So that's the one I've been looking at adding to the portfolio this reporting season. And look, I have to admit, I like James Hardy as well.
Okay, Macca?
JB Hi-Fi is a fascinating one. It's trading at all-time highs. And there's still 12% of this company short sold. That's about 14 million shares. And average daily turnover is 500,000 to 1 million shares. So there's still at least 14 days of trading for those shorts to close themselves down. I've been talking with our head of trading about this one because it's so remarkable. It rose today, Peter. The market was down more than 1% and JB Hi-Fi rose. So I really like that sort of price momentum. Another one that I've been watching because of what's happening with the price is Qantas. Now, since its report, on the day of its report, it tried to zoom over $6 and failed. It tried again the next day and failed. And today it came under pressure. And that sort of failure at a price level that's important is, to me, an indication that it's much more likely to fall further than to
Is this because you haven't been invited in Chairman's Lounge and you're just giving Qantas a good
I am bronze status as a freedom fly paper. That's it.
Okay, guys, thanks for joining us in the program.
Thanks.
Julia Lee from Burman Invest and Michael McCarthy from CMC Markets. It's now time to catch up with the Chief Economist for HSBC in Australia and New Zealand, Paul Bloxham, to see how he's reading the political shocks which are having economic implications at the moment. Thanks for joining us on the program.
Good to be here.
I said to an audience the other day, I'm trained in economics, not in psychiatry. And there's so many political problems going on at the moment, you really have to be a psychologist to work out the impact of all this on economies. Are you finding it just as troubling to work out what's going to happen?
There are lots of uncertainties globally, and I think the way I'm looking at this is you do track it through the indicators you have for the economy, and you can see it very clearly now in things like the manufacturing PMIs and the weakness that's in the manufacturing industry globally, the slowdown we've seen in global trade. What's a bit more comforting is that so far it hasn't really translated into a particular weakness in labour markets around the world. Services sector indicators are holding up a bit better, but what it has done, obviously, has had a big impact on the way central banks are seeing the world. And so central banks are now starting to ease policy. We've seen that pivot, and that's the big thing for markets, I think, the fact that we've got such phenomenally low interest rates and central banks that are running out of room to do more.
Paul, obviously if you run around from Britain with Brexit, the EU issues, you roll into China with its trade war challenges and America with its trade war challenges, when you think about it, it's understandable why business leaders would not be champing at the bit to invest at the moment. Have you ever seen as many challenges like this for business investment when we're not actually in a recession?
Well, this is the thing, right? And so the main impact of all of what you're describing is not necessarily the direct impacts from those things, which of course have an impact as well, but rather the way they impact on sentiment and the way they impact businesses' willingness to do investment and hiring. And I think that's what we're seeing evident in a lot of the economic indicators. There is a lack of willingness to make new investment decisions and a lack of willingness to continue to want to expand in certain locations. I think that's the challenge. That's the challenge we face. Now, if you overlay that with the fact that we therefore haven't got as much investment going on as you'd like, but at the same time we seem to have a great deal of saving in the world. This is why interest rates are falling to such phenomenal lows. And of course, while interest rates are falling in markets to very low levels, central banks are also being forced now to try and deliver support. We've seen the Fed cut rates. We think that they're going to cut further in the next couple of months. And we're seeing hints that the European Central Bank is going to try to provide support for growth as well. So the global rates environment is playing a very big role. And of course, that's feeding back to what's happening in Australia too.
I know it's guesswork, but you are paid to guess economies and markets. If a trade deal surprisingly came out in the next month or so, do you think that sentiment would turn on a dime, stock markets would go up, business investment would start to rise and the threat of recession would be reduced?
Oh, look, all of that would be very positive if that were to happen. I guess the question is, one, is it likely to happen? Two, if it did happen, in what sort of form would it take? And then how sustainable would we believe that to be? And so that's what we're watching. We're watching all the uncertainty that's created by the fact that all of these things are highly uncertain, as you say.
How come, if a lot of our business leaders are worried about the trade war, but we're running trade surpluses 18 months in a row and getting close to a current account surplus, are we getting some demand from China that we wouldn't have got if there wasn't a trade war?
Well, the way I describe it for Australia is, so far, what we've seen offshore and everything we've talked about so far really isn't having a negative impact on Australia as yet on the economic indicators. If anything, actually, you'd say we've been actually a small beneficiary of this story, because as China's growth has shifted from being export-oriented to being more driven by its domestic economy and more infrastructure-oriented, and they're pulling more levers in the policy space, that's actually driving demand for the things that we produce. Iron ore, coal, base metals, liquefied natural gas. We are tied into China's domestic demand rather than into the manufactured export supply chain. And that's really the story so far. And we're seeing that most vividly in the fact that we've got these very large trade surpluses. And as you say, we may be teetering on the edge of a current account surplus for the first time in over 40 years as well. That's all a positive story. The challenge for Australia is that the domestic economy has actually been weak during this period, and it's because the consumer's been weak, and that's in large part, in my view, because we have had very weak household income growth. Wages growth just hasn't picked up the way that we had hoped it would, and so you've actually had decent growth in national income coming through in that trade surplus, but it hasn't flowed through to the household sector in the same sort of way as in the past, and that's pushed the RBA to deliver cuts.
Okay, you talked about business investment being pretty ordinary right around the world. So Australia obviously would be a little bit spooked about trade wars, but economically some businesses are doing really well. But we also had the Royal Commission, the election, the quite controversial policies from Labor into the election. Plus you've got digital disruption for many businesses. There just seems to be a lot of reasons why, as a business owner, you might not want to invest at the moment. Is that a fair call?
Oh, these things are all true, but at the same time, there are reasons to invest too. I mean, if you think about population growth is holding up well, Australia's economy is still doing quite well, reasonably well compared to others. There are reasons to think that investment could be okay, and then the cost of capital is extraordinarily low. I mean, accessing finance is, in terms of the cost of that finance is actually very low.
But
So there are reasons for being more positive.
Yeah, I did leave out the house price drops and all the negativity around that. Has that played a role as well?
I think it has. Clearly house prices falling and the weakening in the housing market has weighed on the consumer spend as well, and that's had an impact. But I think the other thing to keep in mind is house prices look as though they've started to stabilise. If anything, actually they're starting to lift. Auction clearance rates are rising. The RBA has delivered looser policy. They've cut their policy rate twice. We've got looser prudential settings. All of that seems to be lifting the housing market. So we should expect that story is actually going to start to provide some support for growth.
Did you think that the tougher bank lending regime over the last 2 or 3 years also has made it harder for the economy and for consumers to be unbelievably confident?
No, I think it's certainly played a role amongst the factors that are out there, but I think the major factor at work has been that we saw a house price boom that was very, very large, and as we added supply to the market, it slowed down, and I think that's been the major thing that's really weighed on the housing market. I think the major factor that's weighed on the consumer has been weak wages growth. I mean, that's the thing, and we're not alone there either. The rest of the world is facing that same challenge.
I don't want to get you into trouble with the Twitter sphere, but there are a lot of people out there who believe that house prices would drop by 40%. I courageously said people like you and others didn't think that was going to be the case. If a recession did come down the pike, generated from external threats more than local, can you see house prices taking another leg down, a significant leg down?
Well, let's stick with what we're seeing so far. So you're right, house prices have fallen. They fell by 10% between the middle of 2017 and now, about July of this year. They've started to stabilise. Our forecast was that they would fall by around about 10%, so we are quite comfortable.
You were guilty of by association with me, by the way.
To a degree. So the story we had in mind, in part, was that actually that house prices couldn't fall too far before the RBA would have to make sure that they didn't fall too much further, and I think that's exactly where we're at. One of the major mechanisms that I look at is the fall in house prices that we saw has started to feed into lower rents. Rental growth is very slow. Rents are a big part of the CPI. 20% of the CPI is housing costs, and so the RBA has reached this point where they've got to try and provide support for the housing market simply because it really directly affects their mandate. They can't have one big chunk of the CPI running slower and slower all the time and expect to get their inflation target. So in my view, a lot of that's the reason why we've got the housing market stabilised. And the RBA's had to cut partly because rents have been weighing on the CPI. In terms of a further downturn in house price, I mean, that's not our forecast. We think the housing market will actually show a bit of life into 2020 and we'll see a rise in house prices. But of course, if there was a sharp global downturn, then things would have to be shifted around.
Okay. I've never been personal with you before, Paul. I've been, I guess, controversial. I mean,
I've got to watch out here.
Yes, right. But if someone came to you, a family member, and said, should I stay, I'm done really well out of the stock market, should I stay in the stock market? What would you say?
I'd say I don't give financial advice. I'm an economist. I mean, that's the
Well, for your own personal investment, are you turning tail and running away from investing in the stock market?
I'm a very cautious person because I look at all these risks all day long, and of course everything moves so quickly. I mean, the broad story here is, and the message that I would deliver is, firstly, as a house, HSBC, we expect interest rates to stay low for a persistent period of time. And that's one of the things that I think really does reframe frame the discussion. So we've had this view for a long time,
Yep.
the idea as a house that global interest rates would stay low. Lower for longer has been the theme.
Yep.
Our team is now talking about rates staying lower for longer out to 2025. And what I've been able to argue for quite a few years is maybe Australia would be a bit different, and indeed we have up to this point, and we've had higher interest rates than everyone else for quite some time. But it seems that now the world is, this is such a big force at work, the slowdown in investment, the excess saving in the world, and then all the uncertainty we talked about earlier, that lower for longer has arrived in Australia. It's here as well. And we're seeing that reflected in the RBA cutting. Obviously, we think they're going to cut further. They'll be at new record lows soon enough. And we're seeing it in the bond market. We're seeing that obviously the Aussie government bonds, the 10-year has fallen below 1% for the first time. We're at record lows. I think we're now in a world where Australia is going to face this low for longer story. So when you sort of take that bit of information, you say, well, if interest rates are going to stay low, it's going to get harder to get returns from fixed income and from deposit accounts. That pushes people out the risk spectrum to look at other assets, and indeed, of course, it does drive those asset prices higher. We're seeing it in the housing market. We're seeing it supporting equity prices.
So, Cass's last question: if there was no trade war, would your view on the stock market be more positive?
Oh, look, I think the whole global story would look very different if it weren't for what we're seeing in terms of those rising global trade tensions.
I'll accept that as an answer as yes. Thanks, Paul.
Thank you.
Well, Donald Trump has made investing life pretty difficult, and so I've got Charlie Aitken from Aitken Investment Management and Paul Rickard from the Switzer Report to talk about whether this is a buying opportunity. Charlie, buying opportunity, Donald Trump and his mad tweets?
Well, selectively, yeah. I mean, there's always great companies you can add to at cheaper prices. I don't think the world ends on all this. I mean, we did expect a period of extended volatility. You often find Trump gets very excited on Twitter just ahead of like a big G7 meeting, exactly what happened this weekend. Makes a lot of noise, then things calm down. So look, yes, I do think selectively it's a buying opportunity, but mostly in non-cyclical companies that can grow organically.
So, looking at your group of companies, Microsoft fits the bill there?
Yeah, things like, I mean, I'm going to add to a few Nike tonight, things that have been knocked around on China sentiment, things like Alphabet. Microsoft's doing well. I mean, the US reporting season's been pretty good. I mean, the world's the actual stock reporting season's been pretty constructive over there. Yeah. So look, I think you've just in equities you have to be able to handle volatility, and that's as simple as that, and take advantage of it.
Paul, are you thinking this is another buying opportunity?
Look, I'm sort of agree partly with Charlie, partly I'm not. I think Australia's a little different. I guess probably just still's got a little bit more in it. We've had a great run. We've had 7 months. We're up 23% at the end of July. To get sort of 6, 7, 8% pullback now wouldn't be unnormal. And we're probably down about 5%. So I just think the market needs to shake out a few more of the longs. But I mean, I guess I've got my checkbook out. I just haven't quite committed, Peter.
The Australian reporting season's been quite sanguine compared to the global reporting season. I mean, I think that's something I read today. I think 53% of stocks have actually downgraded, or the analysts have downgraded. So the Australian fundamentals aren't quite as strong as what we've seen overseas. So that might be a reason the ASX could just go a little bit further on the downside than other things.
Yeah, but I guess the point is, Paul says 23% rise, and we're
that was the end of July.
That's right, and we're down 1.5%, and all the headlines are saying $30 billion wiped off.
Yeah, we know the market goes down in billions and up in percentages, right? We know that, okay?
So does that mean
that's how it works.
We've probably put $600 billion on and lost $30 billion?
Oh,
look, on a straight sense, we're around about 6,000 at the start of the year. We're now 6,400. Had some really good dividends, so we went as high as 6,800. So we pulled back a bit, but I think it's probably just a little bit more, Peter. But that's just a look. As Charlie says, he does get excited before G7s and G8s and the rest of the stuff, and I guess the US market's again in the same situation. It's August. It's still a fairly thin month, and it's had a great run. So it's just. I wouldn't get too carried away either side.
But Paul, you've said two unusual things to me. You said unnormal rather than abnormal, and that was abnormal for you to say unnormal. But you also mentioned the checkbook. Does anyone use checkbooks nowadays?
Look, I'm an old cash guy, Peter. I know I use a checkbook, but all these people who go go to the cafe and get out their credit card, Peter, and here am I paying with good old-fashioned cash.
You'll
It's
be
quicker
arrested.
sometimes,
You'll be
right?
arrested
It
as a
will be.
gangster, I think.
Probably
right?
Charlie pays with his credit card or debit card, don't you?
Yes, using other people's money too. Yeah.
All right. Okay, so neither of you are worried that this latest Trump play could trip the world into
Oh, I'm worried
recession
about all
and
sorts-
a
no,
big
no.
stock market sell-off.
No.
A lot of
If
people
you-
out there would be thinking,
you
big
look at
stock market sell-off coming.
Now look at the bond market. If you believe the bond market and where yields are today, you should be genuinely concerned about certain cyclical industries or financials or banks or insurance companies or anyone who has anything to do with the bond market. What the bond market's implying. I mean, as we make this video, I mean, US 30-year bonds are 1.93%. US 10-year bond is 1.43%. If they're anywhere near right, I mean, you are concerned about global growth, earnings growth, but inside that you can always find companies that are doing okay. So
Okay.
you can't ignore the gold price, you can't ignore the bond market, you can't ignore the VIX, you can't ignore any of this stuff.
Yeah, but come on, we'll come back to your actual stock plays for our
Yeah,
viewers.
but you've got to acknowledge it. you
Yeah,
know.
but the thing is this: if interest rates worldwide are low, and home loan interest rates are unbelievably low, why is it such a big deal that the 10-year bond rate is at 1.9%? It's only in a historical sense that's 1.9%. We would never believe it'd be possible. We wouldn't believe also that home loan interest rates would be. Isn't this just a new paradigm for a new world where there aren't wage rises? There's digital competition right around the world. And also those people in underdeveloped countries are now competing with our bookkeepers here in Sydney. It's just a new world, isn't it? And that's part of the problem.
Well,
we
it's
don't
all the world
understand.
become Japan, quite frankly. That's what's happened. This is the Japanese example of the last 20 years, and the world's morphing into the Japanese
And they
example.
survived.
Yeah, but there's only the only companies that outperformed in the Nikkei over the last 20 years were growth companies.
Yeah.
Companies that
Exporters.
could grow organically, didn't rely on cyclical economic activity.
Right.
And I mean, the other thing is, I mean, you look at this Jackson Hole symposium over the weekend. Central bankers have got their hands in the air. They're going, what more can we do? These interest rates are down here. We need governments to help. We need
It's
fiscal spending. We need corporates to spend. But corporates don't spend when you've got a maniac setting policy by Twitter.
Yeah, I think the worrying part, Peter, was actually, I thought the Chinese response was the worrying part because it does suggest that they just sort of, I thought a couple of weeks ago, worked out to play a bit nicely together. Trump had eased off a touch, because he wasn't going to impose some tariffs until, December to miss out on so US consumers wouldn't be impacted. Suddenly the Chinese just put selective amount of tariffs on just a small number of goods, but they retaliated in perhaps a sense we weren't expecting. And so, I mean, I think the worrying thing is it just looks like this is going to go on a long time.
Yeah,
and
Citigroup reckons a 60% chance there'll be no deal by November 2020.
Yeah, and maybe that's what the Chinese are playing for. New US president perhaps who will be a little more conciliatory. I don't know, but
But life goes on.
But life goes on, and the market gets used to it. But that's the current. This is the current reason why the market is nervous.
Okay, so we've done the highbrow chat. How are you investing now, Chuck? You're sitting on your hands waiting for it to get to a lower level?
I think there's always stocks. It's the equity market.
So what have you bought this week?
There's 70,000 stocks out there.
Okay, what have you bought this week?
Well, it's only Monday afternoon.
Okay.
I've done nothing in
So
Australia.
you've gone to work today and done nothing.
Absolutely
Done
no. I bought a
nothing.
scrap of 10 cent in Hong Kong. They've been knocked around a little bit. I think it's leader in telecommunications.
You
up
like
there.
10 cent?
Yeah, they're okay up there. I'm doing a few things in New York tonight. We'll buy a little bit of Nike and Google. I mean, I just think the one place I am not invested right here, right now, is Australia. Yeah. I think there's...
It's because it's gone too far up?
Plus the things that we did hold, like Cleanaway, we sold, and and A2 Milk, they just had enormous runs ahead of their fundamentals. So if it gets ahead of this valuation, we'll probably sell it. But the rest of the world, there's still opportunity. So look, I think you can be sensibly invested, but you don't run away from the clearance sale, Pete. Right? Quality is rarely on sale. And you look today, everything's down.
Yeah.
Everything.
Yeah.
Well, it doesn't matter if it's CSL or Boral or whatever.
Yeah. Even the great Switzer dividend growth fund.
Growth fund was down. But
I like buying it when it goes down.
Look, I just think you sensibly approach these things. And I think if we get our heads around interest rates being low for 20 years, what are you investing? Yeah. And that's what people need to start thinking about.
Good point. Stocks are the way. Paul?
Well, look, I'm going to nominate some income stocks, Peter. I think they've all run a long way. That's my only hesitation of these stocks. They were a lot cheaper back in February and March, a lot cheaper back in May when the Reserve Bank started cutting rates. So everything's gone up. Yeah. And they haven't come back much. So, but look, these are perhaps four that I think did a little better out of reporting season. They've come off a little bit. They probably need to come off more to make them attractive. right?
But if it's a bit of a market mayhem for a few days or weeks, could be buying opportunities.
So,
what are they?
so Coles is one. It's the
Yep.
first one. Look, it reported okay last week, a little bit of sales growth.
Yep.
It's losing to Woolworths, but they seem like they've got their act together, and I think they're probably, it can
Little
be
shop will help them.
Little shop will help them. Probably can be
Your
reasonably
kids like
conservative.
little shop, I bet.
Oh,
It's-
trust me, I've got
it's-
ushies everywhere.
Yeah, I'm not sure what an ushi is, but I
It's
know I've got
the
a pile of them
Woolworths
sitting on the table at home.
Right.
I'm not sure. So that's number one. I'm still a huge JB Hi-Fi fan. Look, the short sellers have had to cover positions. But look, they'll probably reset at some level, but when they reset, that'll be attractive. So it might be you don't buy yet, but wait for... That actually held up very solidly today, which does suggest that the short sellers are still covering positions.
Yeah.
Third one is Medibank. Now, it's actually growing...
You've never liked
Well,
Medibank.
I haven't, but Medibank is actually growing policyholders for the first time in about a decade.
Yeah.
Its main brand not yet. It's doing it through AHM, but the main brand is getting close to sort of an even trajectory. So a lot of the risk has gone out of that space. It's not going to grow income, Peter, but I think it can probably provide a pretty stable dividend. And the fourth one is Telstra again, simply because I think there's just a little more confidence that they can hold their dividends. So look, for the income seekers, you're not going to get much capital growth. As Charlie said, these aren't the stocks that are going to really do a lot to your portfolio, but probably are going to be reasonably defensive. Maybe in a sell-off, you just look at them in the sell-off.
Okay, growth guy, income guy. That's Switzer. Thanks for joining us. And finally, if you've enjoyed the Switzer TV experience, please hit the like button and subscribe to our YouTube channel. I'm Peter Switzer. Thanks for joining us. See you next week.